Good morning. This is Larry Edelson with my Uncommon Wisdom weekly market video update for Thursday, April 14th. Well, it's been quite a week, quite a few trading days, let's say the last 10 trading days. I had figured that we were reaching a tipping point in several markets, and indeed we did, especially in gold and silver. Now, there's no question again that I was wrong on the short term in gold and silver. I did hedge up back in December the core long-term gold portfolio, and I was expecting silver as well to fall back into support levels below $30 into the mid-20s. That did not happen. Gold and silver pressed higher, and as you know from my Uncommon Wisdom column from this past Monday, and my Real Wealth subscribers know from Flash Alerts, and my other trading subscribers know from Flash Alerts, I did lift the hedges and I did go additionally long in a gold mining share and a silver mining share, adding to the core long-term holdings for those portfolios. However, I have to say that even though I have ruled out a sharp pullback in the precious metals, that isn't to say that we will go straight up. We won't. It will zig and zag higher, and there will be some pullbacks. The signals that I got merely suggest very strongly that we're past the worst period for the precious metals, the most vulnerable period in which a 20 to 30% pullback could have occurred. That is why I hedged up. And now the odds favor that we will move sideways to sharply higher heading into the June period. So, having said that, I want to go right to the gold chart. Now, this is the chart again that I've been following for you. You'll see that in the last day or so, gold has fallen back below this resistance line at 1463 where it broke out. We're probably going to find some support in there, bounce around in there. But now what I'm looking at is this deep maroon line here that you see on the chart I'm clicking on now. This is a cyclical projection line, and it's pointing to 1550 up to 1600 and change by June, and I expect that's where we'll get. Interestingly, it's starting to sync. The gold market is now starting to sync up with some of the shorter term fundamentals, namely the budget battle in Washington, because by the end of May, it's likely we'll be hitting that $14.25 trillion debt ceiling, and there'll be another showdown in Washington. And so I'm not saying that you should trade off of that. You should always trade off of technicals and cyclicals, in my opinion, not fundamentals, anything but long-term fundamentals, that is. Short-term trading off of fundamentals is a recipe for disaster. Now, I want to go on now and take a quick look at silver here. I have the May futures contract up, which is the nearby futures expiring very soon, but it's showing the most volume still, so we'll stick with that. Silver put in an outside reversal bar, a rather large one, the other day, and it will probably pull back a little bit before thrusting higher. I expect that if the rally continues into June, as I'm expecting for precious metals, that gold will now take the lead to the upside. Silver having really spent a lot of its strength over the last several months, last year or so, more than doubling in value. That's quite a move for silver. And I wouldn't be surprised now for them to leapfrog each other and gold take the lead for the next few months. Remains to be seen, but that's something I think we should be on the lookout for. Let's go immediately to the dollar, which is really the epicenter of everything here. The dollar index just can't get out of its way. The dollar cannot get out of a paper bag, so to speak. It remains incredibly weak against virtually every currency on the planet, and that's what is giving the precious metals and most commodities both short-term, intermediate-term, and of course long-term strength. You'll see on this chart here that the dollar index is still very vulnerable to a crash. If it continues to move lower and takes out the 2008 low around 71 on the dollar index, we could see a major crash unfold in the dollar. Right now it's managing to hang around the 75 level, but it has no life in it whatsoever. Having said that, we remain in very treacherous waters, and I would not be surprised to see some kind of short covering bounce occur in the dollar. I would not stake out any long positions in the dollar personally whatsoever. I'd use any bounce whatsoever in the dollar to basically get out of the dollar, and if you're a speculator, go short the dollar. Now let's go to the Dow Industrials. The Dow is just climbing a wall of worry and holding the support line here. As long as we stay in this area, I can see the Dow easily going up to 12.8, then 13.2, then 13.4. And as I indicated in my columns and my recent flash alerts, the Dow has given me a short-term buy signal, negating the sharp pullback that I was expecting. Basically, the pullback that we got back here in early March down to 11,055 was it. That was a cycle low that I was looking for as far as timing goes in the first quarter of this year. We did not get down to where I thought we would go, which is the 9,600 level. We put on a sharp cycle low, brief cycle low at 11,555, and now we're moving higher. The Dow should continue higher into June as well, possibly even into late summer. So you'll want to stay very close to my updates on the broad stock markets. Basically, in general here, what's happening is that the dollar is dictating everything. Everybody pretty much knows that if there's any sign of weakness anywhere in the U.S. economy, Mr. Bernanke is going to continue to print money with QE3. But it's more than that. If there's any weakness in Europe or additional parts of the world, guess where the onus of responsibility is going to be? On the Federal Reserve. We've already seen in the recent data divulged by the Federal Reserve under a Supreme Court decision that they lost to Bloomberg that during the 2007-2008 financial crisis, the Fed really, most of the money, a lot of the money that the Fed printed and loaned out went to European banks. So you can see just from that the Fed stands ready to bail out virtually anybody in the globe. The only part of the globe that it's not going to have to be facing any kind of bailout situation is, of course, the parts of the world that are growing, which is largely Asia and Southeast Asia and the emerging markets. But the rest of the world, the Fed will, at any time, do whatever it takes to bail out the developed world, the Western economies, and that's what the markets really know. They know that the Federal Reserve will continue to print money like crazy. We also know that in general the private sector, and by that I mean the private citizenship of countries all over the world, with the exception perhaps of Asia and Southeast Asia, is largely becoming very disgruntled with their governments. This is a serious decline in confidence in government, and that will drive money out of bond markets, especially sovereign bond markets, and into commodities and equities. So that's what we're looking at for the years ahead. This is a trend that is very large, very strong, and will continue for quite some time. So please stay tuned.